up nearly 3%, again on the back of numbers. Now, let's cut in straight to that JSW Steel conversation.
Last quarter, due to uncertainty around safeguard duty, prices actually went multi-year slow, which basically creates a lot of pressure, which we saw. But towards end of December, the safeguard duty were restored. They are now there for 3 years. That helped with sentiment. So we enter into quarter four far more positive. We think our margins should expand in this quarter. As we look at next year, we will have higher capacity because blast furnace 3 should be, fully available end of March. We are confident about domestic growth. India, consumption grew about 7% for first 9 months. We think 7.5% will be this year's full year's average. But similar growth we should expect, going into FY27 as well, because if you look at it, despite double digits growths which we saw for last 4 years, including 7 to 8% this year, the per capita consumption of steel in India is just 115 kgs. Global average is about 240, 230, 240 kgs. So we have the headroom to continue to grow like this is fairly large. And we are confident about India as a market, and with safeguard coming in, I think it does create a little bit more stability in terms of pricing and margin outlook.
To give us a sense for the industry, how pricing power is at this point in time. We have seen pricing bottoming out in December 2025, and since then in January we have seen price hikes also happening there. But the pricing trend, how has it been in the last calendar year, and how do you see going into 2026?
Look, so if I go back to March, earlier this year, March, April, that's when the first time safeguard came, and we were under severe pressure, the entire industry prior to that. So we saw prices going up. In fact, in quarter one, HR prices went about 3,500 rupee per ton. But once we went towards close to quarter two, safeguard was expected to be renewed for 3 years. That started to create uncertainty. Safeguard expired in November, and although it got finally renewed after 1.5 months, but that uncertain period created severe pressure on prices. And the reason for that, in my view, are two. One, this year we saw multiple new capacities coming in, and capacities come lumpy. So when capacities start, you basically need time as a country to absorb. But the positive, again, I see is India as a country is creating about 12 to 14 million ton of new demand every year, which simply means that, a 5 million ton capacity will take about 4 months to fully absorb because the demand is growing. But the other reason which also created pressure in quarter three is China. And China, if you look at last 3 years, I mean, 4 years back, China used to export about 65 million ton globally. Today, I mean, last year it was 120 million ton. And this year we expect, I mean, the CY25, we think the number would have been anywhere between 132 to 133 million. So the problem with China is while the production is moderating, demand is still falling, creating a further demand needing to export, which creates pressure on global prices. And we are a connected world, so that also affects pricing in India. But as I look ahead, there are two positives I think will help us in next financial year. One, China demand, contraction seemed to be stabilizing. Plus, China has announced anti-involution, which also means some production moderation will happen this year. So CY25, we saw about 4% production cut. We expect this trend to continue. So when your production is, continuously moderating and you find your bottom for the demand, I think that would be the time the pressure to export out of China will come down. Number two, in FY27, we don't see large significant capacities coming in India.